Hello, my name is AmyEriksen. I'm a financial advisor and I've just finished presenting a couple of brunch sessions on transitioning from investment property to a diversified investment portfolio. So some of the feedback we got, and there was a lot of feedback, I've got some of it here, very positive. People really enjoyed the information we covered, but it's just a little bit too small in our meeting room to reach all the people we want to reach. So that's why we've decided to take it online, and thank you for tuning in today to watch this webinar and presentation. So we're going to be talking about a few different things, and I'll be taking you through some slides. So what we want to do is have an evidence-based decision framework for you. So you want to know, is your investment property performing? How well is it performing? Is it a good part of your portfolio? Is it something you should invest more in, or is it something that you should maybe sell or right size to, invest in other opportunities where the returns might be better? But you'll only know that if you ask some difficult questions and if you crunch the numbers. So as a financial advisor, crunching numbers is kind of my job, and I've made a worksheet, and there's both like a go through Word document version, but which will actually be in a PDF when you get it, but there's also like a Excel calculator you can use. So with something like this, you can understand what is the actual ROI on your particular investment property, or if you're thinking about investing in a property, what's the ROI of that opportunity? ROI is return on investment. It's the return on the money you've actually put in. Because since leverage is quite easy to get on investment properties, it can cloud the numbers a bit, because you think about the capital gains on the whole value of the property, say 2 to 4% on $1 million property. Sounds lovely, and it's good, but only if you've got a small amount of equity that you put in up front. And some people, towards the end of their journey, actually find that they've got a lot of equity and a very low yield because of that. So we're also going to be talking through a few different bullet points, which is why people invest in property. Again, how to calculate your true property return, benefits and risks of property versus other investments, and risk mitigating strategies to avoid some of the big mistakes that people can make when they are making a transition decision. And then we're also going to talk about the 4 different types of financial advisors, and you can learn what type I am. For the record, it's independent, research-led, low fees, no commissions. So that's the kind of work we do, and we're happy to bring it to you. Moving on to the next slide. So let's talk about cash flow and capital gains. This is really why people invest in property. Like I said before, it's easy to get mortgages for investment properties if you already own your own house. That's what we call leverage. So it's very easy to get leverage and to buy a leveraged investment property. And then you want to make sure that you're getting enough cash flow and capital gains for it to be worth the amount you're paying in mortgage interest. So what you'll see when you go through your worksheet, either the PDF version or the Excel version, to analyze each property opportunity or each property that you hold, and you can actually do this in aggregate, but it's better to analyze it property by property, so the numbers don't get averaged out. But what you'll see is usually at the beginning, at the purchase time, most investors will have a cash flow negative property, which means that the expenses of the investment property are more than the rental income into the property. And the expenses come in lots of different forms. Mortgage interest, which is deductible against the income for tax reasons. But also, you got body corporate fees sometimes. Everyone will have land rates, so council rates. You'll have maintenance. There's insurance fees. You might pay a property manager to help you manage it. So all of these expenses, if they come at an ad hoc time, or it's quarterly of this and annually for this, and maintenance kind of springs up on you, then it's not that easy to track. And that's why we see a lot of people underestimating the expenses of their investment property. So going through a specific worksheet and actually putting in the real expenses, including any that you think will come up, helps you figure out whether your property is cash flow positive as in gets more income than its expenses, or cash flow negative, as in the expenses are more than the income. So most properties at the beginning are cash flow negative, and then it kind of flips because the capital gains keep going. Since 1990, as it says on the slide, we've had an average of 5.3% capital gains each year before adjusting for inflation. So at different times in this same period, inflation's been above 7%. So in some years you weren't actually making a capital gain at all, your property was decreasing in value. Now the reason why houses increase in capital gains at quite a steady rate is because of inflation. The other reason is because New Zealand is a country with historically a lot of immigration. But what we saw in 2025 was that immigration has actually, reached quite low levels. Around 10,000 people moved to New Zealand in the year to the end of August 2025. So usually we're averaging around 40,000, and anything below that you start to see a lot of vacancies in tenancies and the capital gains because the demand for purchasing these properties goes down at the same time. So cash flow and capital gains, those are two things to be aware of, and those are what make property investors their return. Now, this slide gives you some examples of the benefits of having a fully leveraged property or a 50% leveraged property. The rule of thumb is the more equity you have, usually the lower your yield. So you're building up equity over time as the mortgage is paid off, as long as you're not on an interest-only mortgage. But the higher your equity gets, the lower your cash flow income and capital gains are as a percentage of that equity. If that sounds a little bit complicated, the Excel worksheet calculator is for you, because you can just plug in your numbers and it will tell you what your yield is. All right, moving on. We say leverage is cheap today, but what matters is your return on your capital. So when I say leverage is cheap, I mean the OCR has been dropping for several months now, and that means that mortgage rates are following suit, not as fast, but they're still average around 4 to 5% at the moment. So most people have quite a low interest rate on their mortgage at the moment, which helps, but it only helps if you have enough of a mortgage for it to make a difference. So that's why we made the calculator, so you can see these numbers for yourself. You can see that in example 1, with half the equity, you're getting twice the return. Example 2, double the equity, half the return. It's a simple rule of thumb. Capital growth. We talked about how it had averaged 5.3% and not adjusted for inflation. But there's a few other things to consider here too. So it's not just that it's maybe not giving you a real return, depending on the year and how high inflation is. It's also that your capital gain isn't money that you can touch, really, until you sell the property. So your capital gain is nice in theory, but it's what we call like an unrealized gain. You don't actually have that money. And depending on the time in the market when you do come to sell, maybe it won't have grown at a certain percentage that you expected because your sales price is much lower than what you were expecting or hoping for. So there's also taxation on capital gains if it's sold within 10 years. So the bright line capital gains tax is already in action. There's potential for more taxes in the future as the housing crisis kind of continues and as inequality grows, there'll be more public support for that. Now, you also have to offset the negative cash flow from your salary. You can't use the capital gains to pay off the mortgage. So like we say, it's unrealized. It's there in theory, but depending on when you sell or if you sell, you might not see it for a very long time. We say knowledge is power, And if you don't know the numbers, a financial advisor definitely should. So I don't want to be too on the nose, but I think it's very important that if you have such a large asset as an investment property, that you know the numbers very clearly. And if you don't know the numbers yourself, it's really important to talk to an independent financial advisor, not a mortgage broker. A mortgage broker can help you get a mortgage, of course. However, their advice will be usually to borrow more money. You want to make sure that's the best thing for you in an investment sense. And that's why you talk to a financial advisor who specializes in both investment strategy and also residential lending, like myself. So, subsidising, we mean topping up the cash flow, but also, the time you spend managing the property, the time that maybe someone else is helping you for free, maybe the accountant fees you're paying when you wouldn't have to pay an accountant if you didn't have the property, stuff like that. There are a lot of ways that money can chip in, and if you run the numbers carefully, you'll actually see that even small expenses over time can really chip into the return compared to other investments. So this is a time to look at the document. If you're watching this presentation, you will receive a link to access this crunch the numbers document. We've called it Investment Property to Portfolio Workshop. And we've also called it the Investment Property Calculator in the spreadsheet version. So you've got those two things. You can fill it out in the privacy of your own home. And if you do run into any trouble, you can just use the QR code on the screen in front of you and book in a call with me. We can run through the numbers together on your investment property portfolio, and I can help you make any judgment calls on, average capital gains or average inflation as well. Okay. If you have found that your investment property is not delivering the returns that you thought it was, and you're, somewhat disappointed with either the time that you're spending on managing your property or the fact that there's not really any liquidity in your portfolio, then you would be looking to diversify out of property. Property is great for, like we said, capital gains and that steady income flow, but it's not good for liquidity, and it's it's slightly higher maintenance than, say, financial assets, where you kind of invest and then the companies do what they do and the markets, lift your returns over time. So here we're looking at alternatives. An alternative, for example, could be a managed fund. And I've selected 3 managed funds and given their average returns over the past 5 years. So 8 to 12%, 6 to 10%, 4 to 6%. These are kind of the returns you can expect from the markets over rolling 3-year periods. We can't compare them like for like because property has benefits and drawbacks. But what we can do is we can line them up side by side, and if you have a portfolio that is all property, just rule of thumb, it'll be a good chance for you, or a good time for you, to be thinking about listing that property and at least moving partially into a managed financial assets portfolio. So what I've seen a lot with clients is, they bought one house and then they leveraged against it to buy their first investment property. Then you see that most people, when they buy their first investment property, they kind of, they get used to and comfortable with getting that steady rental income flow, imagining their capital gains tracking up, seeing all the news that's in support of property investing, talking to their mortgage broker who also cheers them on, and then you kind of get stuck because actually transitioning out of property is a real hassle. Think about it. You got to get the conveyancer, you got to do the listing, real estate agents, tenancy cleanups, that sort of stuff. And then you don't know, am I selling at the best time in the market? And even when you do sell, where do you put that money? What we've seen is, in our example, the person who bought their first home, then investment property, and then usually a second investment property. Those people end up selling it all, popping it into term deposits. In terms of low yielding assets, that's kind of like from jumping from the frying pan into the fire, because while property has, lower growth than, say, the stock market, term deposits are almost the least risky investment you can have, and the yields represent that. So oftentimes, if inflation is high, your money will actually be losing value in the term deposit, and we do want to avoid that for you and your children and your legacy and any charities you support. It's important that your money is working hard. So property versus the managed portfolio, we've got a few examples here of what each is good at, and we got part 2 of that because there's a few details. So property, time intensive, there's income tax on the gains, tenant maintenance stress or property manager stress as well, versus the managed portfolio. We do a wealth management service, and this is what I'm referring to when I say managed portfolio. So what we do is you invest money with an independent platform, and then we upload recommendations for you to action when it suits you. We'll be proactive with our recommendations, and all of our recommendations will be to suit your investment objectives. So if you want a return of, say, 8% per annum, we will be putting in a portfolio that should achieve that on a rolling 3-year basis. Of course, listed markets go up and down, and they do so more often than property, because you can buy and sell a share every day, but no one buys and sells a property every day. So that's why you've got more volatility. But Eriksens as a firm has actually specialized in low volatility portfolios for over 50 years, really. So we started as an actuarial and investment strategy consulting firm, but we are now doing investment advice for individuals, their families, intergenerational wealth transitions, as well as our institutional business, which has around 5 billion of assets under advice. So when I say managed portfolio, I mean we are giving the investment recommendations, and it's expertly, constructed. We say we construct a portfolio for you, and then we can manage that on the platform, but you have the final say over anything that goes in and out. You can make transactions anytime thanks to the free platform we use, and also you can check the performance and get tax reports at any time too, which is very helpful. You may have seen it and picked up on this in the previous slides, but now we're going to talk about the diversification advantage. So property is very concentrated. You have one property in one place, versus a managed portfolio, which is very diversified. So there are a few different ways to diversify. We like to diversify by both manager, but also asset class. So you want to be holding a lot of different asset classes, as well as several different managers, because each fund and investment manager will have a different style. And what we've seen over time, or what research shows as well, is that every asset class has its time in the sun, and also most managers have their time in the sun. Some managers never win, they're never in the top quartile, but very few managers are consistently in the top quartile of returns. And that's why it pays to have a financial advisor who can actually meet one-on-one with the fund managers and talk to them about their products and get an inkling of what their actual style is, what their biases are, and how that's going to fit into our clients' portfolios. There's also the peace of mind factor. In our property investment branches, there was talk about, worrying about, is leaving this house for the kids a good idea? Are they going to want to be able to pick up the property maintenance jobs? My son's not a good painter, my daughter's overseas. There's a peace of mind factor from having a liquid portfolio managed by experts. New Zealand has a great DIY culture. I myself like to paint a wall now and then, but it's very important that your investment portfolio matches your lifestyle. And if your investment property is giving you stress or becoming a burden, then that's a sign, not necessarily a financial sign, but definitely a sign that seeking financial advice would be wise, because it's very important that you are able to sleep well at night. That's part of what we deliver for our clients. When it comes to exiting, the choices that you make can result in very different financial outcomes. We call this the $500,000 difference. So if you do a professional transition and you get independent financial advice before and while you're doing it, then your strategy should be tax optimized, it should be diversified, and it should have good returns going forward that meet your needs. If you do it yourself, we've seen worse returns. And I guess that's because financial advisors and investment strategists, we work full-time in finance, whereas if you're doing it DIY, it's probably on top of your primary job. So just not enough time and maybe not enough experience in it. But there are a few things that people need to consider before that. So I'm open to change, but there's a lot of different reasons that people get stuck or prefer property investing. Like I said earlier, it's a big thing to transition out of even just one property holding. There's the conveyancing, real estate markets, selling, tenancy checkups, etc. So we say good advice is a must. A good real estate agent is also a must. You don't want to be paying, I was talking to someone the other day and they said, I paid $5,000 each month for this property to be sold. It was just lighting it on fire. And in the end, the property never sold. So you really want a good real estate agent who can close the deal. And then you want a plan for your portfolio. You don't want the settlement to happen and then the money to sit in term deposits and for you to think, I should invest at some stage. All right, you want to get that plan in place. You want to get that portfolio in place. And you want to be really comfortable with the investment recommendations you've received and the investment strategy that your financial advisor has devised for you. What you don't want to do is take information from a general investing blog or like an LLM like ChatGPT, because that will give you kind of really average investment advice, which would be not so harmful if it wasn't such a big lump sum. But if you put all the proceeds of a property sale into average advice made for regular savings, that's an incredible risk, and you're likely to experience far more volatility than if you had a diversified portfolio set up by experts who actually implement, millions of dollars each month. I talked first about the mistakes, and as promised, here they are. So there are 5 main mistakes that people can make when they're transitioning from property. So there's tax. And we've got some questions in our worksheets about how long have you held the property, because now there's 10 years, bright line. There's also portfolio structure. We talked about both the DIY approach, but also people just putting it in term deposits. That's actually going to lose you money in real terms, which is a real shame. That's not what you want for your retirement fund or your children's inheritance or your charitable donation once you're gone or while you're living. Market exit timing. So if you hold property until you distribute it, say to your children, for example, likely your children will sell it when they get it. If there's multiple children and there's only one property, an investment property, then they're going to split it, right? They might borrow against it, but that can lead to sort of squabbles and unfairness and that sort of thing. So usually we see children sell the investment property when they inherit it. Who knows what the market will be doing then. So that's what I mean about market exit timing. You don't want to panic sell because you've run the numbers and you're not happy, but you also don't want to sell just immediately when you get it, when you first inherited it, because that might not be the best time in the market either. Cash flow gaps. People get really used to getting the rental income, and if you have no mortgage on the property, one, your yield will be very low in terms of the income versus the whole value that you have in the property, but it will be very comforting to get like a weekly or fortnightly cash inflow of that rental income. Very reliable, as long as you have a tenant. Very reliable, right? So we work with our clients to make sure that they have the income they need from the portfolio later on. And you can set and forget that in a way too. So there are things like income funds which will distribute a small amount, but they have very low growth because they're made for distributions. But there are also different ways you can set up automatic withdrawals, and that way you can replace your income. And we can help you do that and choose the best asset to take the withdrawals from at any one time. Then emotional decisions. A few people actually have their first investment property from their first home. So they loved their first home, they kept it as an investment property, they moved into another home, and they really don't want to sell that property, that first one. There's room for that. Not every decision is purely numbers. Even as a financial advisor, I think there's, weight that should be given to your personal preferences, of course. However, you just want to be clear-eyed about that. How much weight are you putting towards your feelings about it, and how is that going to impact your portfolio? If it's stopping you from living the life you want, that's when I would say, let's make a hard decision. But in all other cases, just as long as you know, that's enough information. All right, we say each mistake can cost you 6 figures over time. Can be worse, can be slightly better, but yes, usually around that. At least 100K if you get these things wrong. That's why we made a wealth transition process to kind of simplify it. First, you want to do analysis. So part of that is the worksheet, part of that is talking to a financial advisor to get some insights on your current portfolio. And then the next part is strategy. You want to do timing, the structure of the new portfolio, risk management. That's also where an independent financial advisor, especially at Eriksens, because we have actuaries on staff who are professional risk managers. You want to think about how will you be better off with these better returns. Part 2 is execution. That's when you actually do the thing. So coordinating the sale with a real estate agent, getting a tax-efficient settlement, portfolio construction, you're selling the property at this point. It doesn't mean you should sell all your properties, but if the numbers on one property are particularly poor, that would be the one to sell. Number 4 is wealth management. So this is where we come in full flight, although we've probably been involved from the beginning in terms of setting your investment goals, but also doing portfolio construction and some preliminary recommendations. But wealth management is where you outsource the recommendation part. So you don't have to figure out which stocks or which shares or which funds to buy on your own. You don't have to ask Reddit, what do you think is good? What you want to do is get a portfolio tailored to you. So we'll do a whole fact find process earlier on, and that will help you figure out kind of what your goals are and also what's most important to you. This can also include your ethical values and other considerations, and also different cash flows needed at different times. Say if you want to give an early inheritance to your children, or if you want to have a certain amount of money before you actually retire, we work towards those goals with you. And then we put it all into recommendations that we upload on an independent platform, and then you can put your money securely with a third party, and then you can approve our recommendations as you go. So in the last slide, we simplified it down to 4 different steps, and you might be tempted to think, oh, okay, I can do this myself. So I just want to draw your attention to the fact that in all of those 4 stages before we recommend personal financial advice from an independent financial advisor, as well as other experts as needed. So conveyancers, accountants, real estate agents, because what it costs to get it wrong, it's extremely high because the asset value of an investment property is very high. It's a large lump sum. So I've got a few examples here: tax timing errors, poor diversification, panic selling, and just what they can cost specifically. And we got a bit of a potential cost sum. Not that you will make any of these mistakes, but that people can, and they do. Now, we're talking about financial advisors, but who to choose? There are 4 different types of financial advisors in New Zealand, and I know this because I did a SWOT analysis when I decided to open up our personal financial planning arm. So we've been doing investment strategy and actuarial consulting as a firm and as a family as well for about 50 years. But this is kind of the first year that we've actually taken our skills on the wholesale side, which is large portfolios, professional investment strategy, and delivered it to regular people, people like you and me, who have, small portfolios, but we still want good returns. So when I was looking through the business models for different financial advice providers, I found out that none of them really prioritize the client. You got 3 different types that don't prioritize the client, and then you've got Eriksens. And shockingly, we're actually one of a kind in New Zealand. So let me take you through what the landscape of financial advice is. Okay, 1, you've got your salespeople. I say this because they are selling a product or they are selling a strategy for another firm. So salespeople, you'll find them working for fund managers or giving advice for free. So they're not volunteer financial advisors. That's not a thing. What they are doing is receiving commissions, and those commissions will usually be trailing amounts that are taken out of your KiwiSaver or the managed funds for however long you're invested. Because fund managers pay different commissions for different products, that introduces a bit of conflict of interest, right? So a financial advisor might receive a higher amount for a particular product, and that can incentivize them to recommend you go into that product. Financial advisors do have to disclose this, and they have to disclose it early on. So when you meet with one, they'll say something like, I'm only allowed to advise on these particular products, and I get commissions from maybe these particular KiwiSaver funds or something. So their advice might not be wrong, but if you limit the universe of investment options to choose from, you're limiting your potential returns. And if your advice isn't independently researched, and if the research is, outsourced and is done by a third party, and then your financial advisor is just kind of delivering it, you don't know that you've got the best strategy for you. Could be like a cookie cutter kind of model portfolio approach. And then, you may as well just be Googling because if you outsource the strategy, there's no guarantee that your financial advisor actually understands it, and there's no guarantee that when crunch time comes or an asset class falls significantly in value, that you'll be protected, because there's a lot of groupthink if you're outsourcing strategy. So that's 1 to watch, salespeople. 2 is those large investment firms. So a lot of these firms actually started as share brokerage firms or trading firms or investment banks, and a large part of their revenue comes from fees on transactions and placing different products. So they make a great profit margin, and they will spend that on advertising on Air New Zealand or going on billboards and whatnot. And again, it's not that their investment advice is inherently wrong or bad, it's just that the incentives aren't aligned with you particularly. So if you get revenue from transacting, then you're going to make more transactions in a client portfolio. If you have a set amount of shares in a company that you need to sell, you'll be putting those into your clients' portfolios with slightly less consideration for who it's appropriate for, perhaps. It's just how revenue structures and businesses work, right? If you're set up with a certain revenue stream, you want to maximize that revenue stream, especially if you have external shareholders. So you can spot these ones pretty easily, and they'll also be the ones that are charging quite high advice fees. So we've seen some portfolios come in around 1 to 1.6% per annum, which is much higher than the 0.5 to 0.75% that we charge for advice fees. The third type of financial advisor we're covering are planners. Now, a financial plan is really important, and at the beginning of your wealth journey, you really want to have a solid plan. The focus of financial planning often in those early stages is on budgeting and savings rates and paying off the mortgage. So really great stuff, right? If you have less than $100,000, then your savings rate is probably going to be more important than your investment returns rate. That said, when you're at the $100,000 mark, or you've gone beyond that, perhaps with an investment property or two, investment strategy is what counts. The difference between a 5% and a 10% return is going to be much greater than the difference between a 15% or a 20% savings rate if you've got a large chunk of capital already accumulated. So for that reason, you need financial planning services, yes, and we do offer them at Eriksens, but you want to go to a firm that is not planning first. You want to go to a firm that's investment strategy first. The other thing to note about financial plans is that they can go out of date quite easily or quite quickly as your life situation or circumstances change. Say if you get a higher paying job, or if you want to move cities, or if you need to cover an unexpected but large expense, or take some time off. If that's not in the plan, to rework the numbers, you need to get another financial plan, and of course that costs each time if you go to a financial planner. At Eriksens, we do it as part of our wealth management service because they go hand in hand, right? So that's just one thing we do to help our clients. Now, number 4 is Eriksens. We are actually independent financial advisors, so we're not partnered with any fund managers, we're not getting commissions from any fund managers, and we're not running our own products. We also do our own research in-house, and we have a highly qualified team to do that. We keep our costs low by having like a small office, not doing a lot of advertising, and we aren't run for shareholder profit, which means that our pricing, covers the salaries of our wonderful staff, but it's not, used to pay a dividend to some shareholders who are used to buying yachts, etc. We are also a family-owned and operated business. So my grandfather, my father, and myself now, Eriksens has been doing actuarial and investment consulting for over 50 years as a family in New Zealand. And our business now, there's almost 20 of us now, but some of them are admin stuff. But we, it's not just Eriksens in the business, but we all kind of value family and people first, and that's why we've made our financial advice service so client focused and, putting the client first in our pricing. So our clients benefit from having cost-effective wealth management. It gives them peace of mind, and it gives them better returns than they would have otherwise. Yeah. We've talked a lot. We're getting to the end of it. Back to property. Your 3 options. Depending on what the numbers are in your worksheet and in your guide, and again, if you want to, book in a call with me using the QR code and we can talk through the numbers together. But you've got some options. You can hold, you can partially sell and partially hold, or you can do a full transition out of property. Now, I've talked about who these are best for as rules of thumb, but it's also an individual choice, and it's really a case-by-case basis on what is best for you, given the numbers, your life stage, and your liquidity needs, how much cash you're going to need in the future. So if you continue with property and hold, rule of thumb, this is best if you're younger and have high leverage, because that increases your yield on the money you've actually put in, and if you can sustain the cash flow, especially if it's negative cash flow, as it usually is in those early days. 2, keeping some, selling some. If you've got multiple investment properties, this is probably best, because you don't want to be 100% of your net worth in property. That's not diversified enough, and it's not liquid enough for most people's cash flow needs. So we say right sizing your exposure to property, and we can help you decide what percentage is the right size for your needs. A full transition is selling all investment property and building a managed portfolio. So this is when you want to be more hands-off, you need more liquidity, you're getting close to distributing for inheritances or charitable donations, but it's also if you just want higher returns. So usually it's easier to get higher returns outside of residential property in New Zealand, just because leverage is quite easy in New Zealand, which means that the purchase prices keep getting bidded up and up, which makes it hard to find a really good opportunity. Here are some questions you can ask if you're not sure about where you're at in terms of the, hold, partially divest or fully divest. You can say, am I comfortable with my current concentration risk? Are you happy with your net worth as it is? Is it 100% in property? Is it 100% in managed funds? It's good to have a balance, right? Can I sustain the cash flow if rates stay high? So at the moment we're in a low interest rate period, but interest rates can and do rise, and the long run average interest rate in New Zealand is about 6%. So can you do the cash flow top-ups if your mortgage payments are 6% on the investment property? Do you have energy for ongoing property management? Or also, is your property manager doing a good job? Are you having to manage them? And do you have the energy for that? And then tax positions. Bright line tax is still in effect. So have you held the property for 10 years? If not, you're likely to pay tax on the capital gains. And it's likely that in future, you might have more taxes to pay on capital gains as the housing crisis continues and inequality might grow and populism, politics, etc. So things to consider there. Here's what we do, but I think you know that by now. Evidence-based advice, transparent process, and better returns with lower risk. That's what we're offering you, but as a firm, we do a wide variety of services from, analysing individual stocks for people to analysing the cost of a business that's selling for a new acquisition target. We also do separation valuations when people are going through divorces, figuring out what's fair and what's not fair, and supporting their lawyers with some independent numbers. We do a wide range of things here. We started as a consulting firm and we still consult today. So anything with numbers, basically you can come to us, we can give you a fixed fee quote and we can get started on your project. But for you personally, if you're watching this, you're probably a property investor and you're curious about what diversifying looks like. So the service we present to you would be the wealth management service, where we can help your portfolio get better returns with more liquidity and lower volatility than say a DIY portfolio. Here are some of the people in our team. Okay, so lots of lovely faces. I'll call out some of them. Colin Downey, Jonathan Eriksen, and Peter Knox are all trained and qualified actuaries. Rosanna Eade is an actuarial analyst. Adam Muir and Andrew Simmons are mathematicians. Adam's a maths grad, but Andrew Simmons has a PhD in mathematics from Cambridge University. Ross is a finance grad like me. Gail and Tal are just fabulous people. They work in the comms team, but they also do financial advice, client support. Andrew Franklin is a chartered financial analyst. Adam Muir is pursuing his CFA qualification as well, if you've heard of that. And Peter Verhart is our head of investment consulting on the wholesale side, and I head up the retail financial advice section. Yeah, lovely team. And there's a couple of admin staff. We have a graphic designer on hand and an administrator who works from overseas, so a lot of backup. If you're wondering what to do next, your next step will be a complimentary review. So here's a QR code to book in a call with me, and we can analyze your property portfolio. We can look at different scenarios, holding, selling, partial selling, and a transition strategy for your situation based on your goals. So it really helps to talk to an expert in financial advice for this, and there's going to be no cost, no pressure, just clarity, but hopefully a bit of fun too. And you can scan the QR code to book in my calendar now. I hope you've enjoyed this, and I look forward to talking to you soon. Bye.